Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. First question from Benjamin. He says, right now, I'm looking at a CD and I could get maybe about 4%. This is investing by contract. Seems like it's guaranteed, so should I invest in this CD? Benjamin, that's a prudent question, especially considering the current CD rate you're looking at, right? A 4% return on a CD does seem attractive, and historically speaking, such rates, they haven't been common in recent years. However, it's crucial to look beyond the initial allure of guaranteed returns and consider the broader financial landscape. Let's dive into this further. First, historical context is essential here. High CD rates, like the ones you're considering, often appear during periods of economic conditions that may not be sustainable over the long run. In 1980, when high CD rates were prevalent, subsequent declines in interest rates meant those who locked into longer-term investments like government bonds benefited greatly over time. Now, if you're looking at this CD as a short-term investment to cover upcoming expenses like buying an RV or funding college tuition, it could serve you well. CDs offer safety of principal and a predictable return, which is ideal for short-term financial goals where you can't afford to lose money. However, for retirement planning, it's a different story. Retirement planning spans decades, potentially 20 or 30 years or more after you retire. Placing retirement funds into short-term CDs, even at a high rate, may not align with your longevity of your financial needs in retirement. Inflation, which erodes the purchasing power of your money over time, could outpace the interest earned on CDs, especially if interest rates decline further or remain low for an extended period. Therefore, when considering investments for retirement income, it's crucial to strike a balance between seeking higher returns and managing risk. Diversifying your retirement portfolio with a mix of assets that offer income generation and growth potential while considering your risk tolerance and time horizon. This approach can help mitigate the impact of fluctuating interest rates and inflation over time. Great question about CDs. If you would like to send in your question, you can do so. You can email those questions to poollocke@poollocke.com. So our second question is from Danielle. She asks, I have a fixed indexed annuity. Does that have high fees? Okay, so that's a great question, especially concerning the fees associated with fixed index annuities, right? Now it's important to clarify that fixed index annuities typically don't have fees in the traditional sense. Here's how they work. A fixed indexed annuity operates similar to a fixed annuity where you earn interest based on a fixed rate. However, with the fixed indexed annuity, the FIA, the interest earned is tied to the performance of an external index, often like the S&P 500. If the index performs well in a given year, you receive a portion of that gain as interest credited to your annuity. If the index performs poorly, you don't lose your principal, but you may not earn any interest for that period. Now, where fees come into play is if you have an income rider attached to your fixed index annuity. An income rider guarantees you a lifetime income stream, akin to an immediate annuity, but with more flexibility. The rider typically incurs a fee, typically around 1%, 1.1, 1.2. So this fee ensures that you have the option to receive a predictable income for life while maintaining the ability to adjust your income levels as needed or even cash out of your annuity if circumstances change. It's important to differentiate fixed index annuities from variable annuities, which do carry higher fees due to their structure involving sub-accounts that resemble mutual funds. Variable annuities can have fees ranging from 1.5% to over 3%, making them more costly compared to fixed index annuities. So the key takeaway here is that while fixed index annuities themselves generally don't have fees, the presence of an income rider could entail a modest fee for the benefit of guaranteed lifetime income with flexibility. This fee is a trade-off some individuals are willing to make for the security of knowing they'll receive income for life without the risk of running out of money. As always, understanding the specifics of your annuity contract and how it aligns with your retirement income needs is crucial. If you have more questions or need further clarification, give us a call. Feel free to ask. Hey, great questions today. As always, if you would like to send in your question, we'd love to answer it. Email it to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.